Bonjour tout le monde. Good morning, everyone. My name is Paul Bennett, and I'm a director on the board of the Ottawa branch of the National Association for Federal Retirees. I would like to begin by acknowledging that the land on which the branch office is located is the traditional unceded territory of the Algonquin Anishinaabe people. On behalf of the branch, I am pleased to welcome you to today's webinar, the final in a series of 3 that our presenter has called 3 Secrets of Successful Investors. Today's topic is low-cost, diversified portfolios that take all the work and most of the worry out of investing. Our presenter is none other than branch member Michael Fine. Over the last 5 years, Michael has designed and offered very popular workshops and webinars on investment matters that have reached over 1,800 of our members. Michael has an MBA and successfully completed the Certified Financial Planner courses. Although he has never worked professionally in the industry, he has spent a lot of time managing his own family's financial interests. Michael is dedicated to helping retirees get the information they need to make well-informed investing decisions. And it's important to note that his views are his alone, and he receives no remuneration from any source for these webinars. Michael is a former provincial deputy minister and federal director general. He spent half of his career abroad, giving him a unique perspective on the world economy and Canada's place in it. Before proceeding to today's speaker, there are a few things I should mention. First, today's webinar will not provide investment advice, and Ottawa branch takes no responsibility for any investing decisions that participants may make. Veuillez aussi noter que le webinaire sera présenté en anglais, mais la participation bilingue est toujours encouragée. I also want to give a special welcome to anybody who's not yet a member of the association. We hope these webinars will inspire you to join us, and to our members, we hope that these sessions will encourage you to maintain your membership. Something important to note is that our mega recruitment drive is back. From now until December 31st, every time you successfully recruit a new member, you will receive a ballot to win one of 14 great prizes, including a grand prize of $10,000 in cash, courtesy of Johnson Insurance. All members who successfully recruit a new member will also receive a $5 Tim Hortons gift card. There are no limits to the number of times you can be entered into the grand prize draw, so the more new members you recruit, the more chances you'll have to win. After today's webinar, we will send you an email with instructions on how to access the recording of today's webinar, more information on the mega recruitment drive, and how to join the association. Remember too that you can always invite non-members to register for our webinars as guests and try us out for free. There will be 3 polls during the presentation. After the questions appear on your screen, please select your answer. Michael will tabulate and then discuss the results. Please type your questions in the chat box throughout the session. Michael will answer them during the Q&A period following his presentation. Now, I'm going to turn the presentation over to him.
Okay. Thanks very much, Paul, and thank you for the introduction. And good morning, everybody. Well, it's certainly been an eventful few weeks if you've been watching the stock markets and various other happenings. I was saying earlier that watching what's going on in Florida has been pretty devastating because it's a place that I know well. And I was very close to buying a place in Florida last year, which was in the area that was fairly hard hit. So, but my wife has been very good in not saying once, gee, aren't you glad you didn't buy that place in Florida? Anyway, today we're going to talk about how do we come up with some portfolios to deal with these very volatile times and try to get a sense of what we as seniors should be planning looking forward, because quite frankly, there's so much going on out there in the world, political, economic, markets, climate change. It's a really difficult time. So give me a minute to get the PowerPoint up and going here. Okay, so we're going to talk about low-cost portfolios that take the work out of investing. As usual, we have our disclaimer that this webinar does not provide investment advice, even though at times it may sound like it. I want to remind people that all investing comes with some risk. The more return, the more risk. And that before making any investments, you should consult a qualified financial advisor or do your own extensive due diligence. So here's the first poll question. And by the way, to answer, all you have to do is click on one of the answers, or if you have a touch screen, tap on it. But just to get a sense from you, it is most important that my investments provide 1, an ongoing source of income, 2, long-term capital gain, or 3, preservation of my capital. Please vote now. Okay, I think everyone has voted. So about 45% of you have selected an ongoing source of income. And that makes a lot of sense, particularly for us seniors. We want our investments to provide some extra income for us. 25% are looking for a long-term capital gain, and 30% are looking for preservation of capital. And by that, what we mean is, frankly, we'd like to maybe have some income, but we don't want to lose money in the process. And to say that that's a challenge today is being kind. So one of the things that I think we have to keep in mind, without going crazy about it, is the fact that we are entering a period of profound economic, global, and domestic instability. This was a quote from Andrew Coyne from the Globe and Mail, and you may have seen Andrew. He's one of the talking heads on CBC every Thursday night. But, you know, and not to overdo it, but when we look at the fact that we've got things like Russia, Ukraine, Putin, Iran, China, maybe to a lesser extent, and then the economic turmoil that the world is in, particularly Europe and Asia, and then domestic instability in the United States in terms of its politics. You know, it's awfully hard to figure out what may be coming next down the pike that's going to affect markets or economics in general. So we have to kind of keep this in mind, but on the other hand, we have to keep going on with life, and we have to keep going on with our investments. The other thing I wanted just to show you, and again, I don't want to overdo this, but one of the key indicators that the economy is going to get worse and go into recession is what's called the inverted yield curve. And I just want to show you what it looks like. On the left here, you see this graph of it. The blue is a typical yield curve. So basically all a yield curve says is that as the years to maturity, like the length of a bond, go up, then you expect the interest rate to go up, as it shows in this blue curve. On the other hand, an inverted yield curve, the yields go down with time. So the yields are actually higher. I mean yields, I mean interest rates are actually higher at shorter terms than longer terms. And the issue is that 80% of the time, this inverted yield curve predicts recession. That recession will follow within a year. It's about 80% accurate. Now, look over here. These are US bond duration and interest rates as of yesterday. So you can see the 2-year rate was 4.1, the 5-year is 3.8, the 10-year 3.6, 30-year 3.7. So the 2-year interest rate is higher than all these three. So it would make this red curve here more like this, even more pronounced. And as I say, that's a pretty good indicator that we're heading into tough economic times. The reason why is because what it means is that the people who buy bonds, which are the professional investors for the most part, big pension companies, insurance companies, that sort of thing, they want to lock in their income because they think things are going to get worse. And so they're willing to pay more, therefore get better yields, or sorry, lower yields out here because they want to lock in their return for the long period of time. And when you pay more for a bond, the interest rate goes down. We've talked about that before. So let's go to poll question number 2. From March 2000 to March 2012, the S&P 500 made zero. In other words, if you look at a graph from 2000 to 2012, there was no gain overall. However, by reinvesting dividends, an investor made a gain of 0, 25, 50, or 100%. What do you think? Please vote now. Okay, I think everyone has voted. So if we look at the results, about 50% of you said 25%. And the actual answer was 50%. And I'm going to show you why that's so important. So, and one of the main messages I want to leave with you through this is that even in a time where stock markets may go nowhere, by investing in the right kinds of things that pay dividends, you can still profit, even in a market that, frankly, you might think otherwise you couldn't profit from. So some of you have seen this before, but this is the graph that basically explains the point we were just talking about. If you look at the red line, that's the actual value of the S&P 500, which, to remind people, is the 500 largest stocks in the United States. And I use this because it's such a big, broad market. It's, you know, companies from that are doing business all over the world. So it's a lot more diverse than the Canadian market. So you can see here, back in early 2000, the S&P 500 was at 1,500, and it went down, and it went up, and then it went down, and then back up, and way over here in 2012, it was back to 1,500. So 12-year period, it did nothing. But this blue line shows what happens if you had just reinvested the dividends in a non-taxable account, so that you paid no taxes, and reinvested dividends usually can be done paying no fees. And in that same period of time, it went from 2,000 to about 3,000, a 50% increase. And the reason this happened is because if you just had it on automatic reinvestment, as the markets went down, you didn't think about it, and it forced you to buy low. And so every time the markets went down, your money got reinvested at a low rate, and in the end, you did well. So if there's one takeaway from this seminar today, is that you can still do well as long as you keep reinvesting those dividends in a non-taxable manner. Now, some of you watched the earlier one. We talked about the choices that you get for the types of investments in your local bank branch. And I just wanted to show you this follow-up, the video of, anyway, so the basic point there is that if you go to your bank branch, you get cheeseburgers, and you only get cheeseburgers. And the problem is that the things that I think I should be investing in over the next number of years, I can't get from my bank branch. So you've got to go elsewhere. And that probably means that you've got to set up your own online discount brokerage, or find another means of doing so at low cost. So for example, things you can't get at your bank branch, I want to talk about dividend ETFs. So this is a form of providing income. And here are just some examples. I just picked these to give you a broad example of things. But here's XDV is a Canadian dividend ETF. They pick some of the highest paying dividend companies. It's basically banks, pipelines, telecom companies, that kind of thing. XDV is very similar, or ZDV very similar. And XHD, which is American stocks, is but bought in Canadian dollars. So you can see the 10-year average annual return, and that's after the recent market turndown. So, a few months ago, these were higher. You can see the dividend that they're currently paying at 4.6%. And you can see the management expense ratio. Now, for those of you who may have watched last week and seen the session on taxes, you'll remember that to get the interest rate equivalent of this before tax, you have to add 30% or so. So that would mean that this is about 5.8% as a interest equivalent. So that's one source, very simple. You buy one ETF, it pays the dividend. You can set it up to reinvest automatically if you don't need the cash, and you're done. You don't have to pick any individual stocks. Another option are called real estate investment trusts, and these are companies that invest in, say, shopping centers, senior citizen retirement homes, office buildings, hotels, the works. And these have been quite beaten up over the last while, such that the 10-year annual return has dropped. But you can see that one of them, RIT, which interestingly is an actively managed one, where these other ones just use what they call a passive system of picking the investments. You can see it's returned about 7.2% over the last 10 years, which was about the same as the dividend stocks. Its distribution yield, again, is about the same, 4.8%. The MER is a little higher on these because they tend to be smaller funds. But these, particularly if held in a TFSA or in a tax-deferred account, such as an RSP or a RIF, are good ways to, again, earn some pretty decent income. So real estate investment trusts. And again, all you have to do is buy one of these, put it away, set it up for reinvested dividends, and you're done. Now, for people who want capital gains, typically what happens is that we look at a broader type of index and expect to get a little more capital gain, but lower dividends. So XIU is a Canadian ETF that owns the 60 largest companies on the Toronto Stock Exchange. XIC here owns all the companies in the TSX 250. And VOO is a ETF that owns all the stocks in the S&P 500. This one is in US dollars, where these are in Canadian dollars. And you can see overall the 10-year return. Again, they're in that 7.5 sort of range. VOO, the S&P 500, was higher because the US stock market, frankly, just blew away almost every other stock market in the world. And you can see the relative dividends. You can also see that the MERs are a lot lower. Look at the MER on VOO at 0.03. I mean, it's almost nothing. So again, for some capital gain ideas, these are just a few to give you examples. There's also an option to go to what are called all-in-one ETFs, where they own stocks and bonds. And you can see this one here, VGROW, has 80% stocks, 20% bonds. Its 3-year return is only 3.7% because, frankly, the last year or so has been so bad, it's really dragged it down. And VEQT is basically stocks of the world. And again, you can see the annual return. So these are for people who are more focused on capital gain, want an all-in-one solution, and you just put it away and forget it. For capital preservation funds, which some of you are interested in, I'm looking at what are called balanced ETFs, or balanced low-cost mutual funds, and they tend to have a 60-40 stock bond split. Or in the case of this one by Mauer, it's 60-30-10, with the 10 being cash. Again, the 3-year annual returns have not been great. Again, because it's such a short period of time, and the last year has been pretty terrible. If you look at Mauer, though, over 10 years, it's returned about 7.25%. Are you getting the theme here that everything is returning around 7.5% over time? And again, you can see the dividends, and again, you can see the MER. Mauer is higher because it's an actively managed fund. Now, the interesting thing about Mauer is that you cannot buy it through your local bank branch, but if you are somebody who likes mutual funds rather than ETFs, and you want something actively managed, you can buy Mauer through an online discount broker and pay no fees and only pay this much in terms of the MER, 0.92. So just to give you, again, some examples of these balanced funds. So let's go to poll question number 3. Over the next 5 years, I expect the stock market to decline, increase, go sideways. I know, but I ain't telling. Please vote now. Okay, I think everyone has voted. So 46% think that the market is just going to go sideways. 34% think it's going to increase, and 20% think it's going to decline. So that's interesting. My personal feeling is I really don't know. It's impossible to tell. And anybody who tells you that they really know what's going to happen is probably lying. So let's talk about where and how you should invest. And the key determinant is your timeline. When do you need the money? And remember that past performance is no guarantee of future results. So all this stuff we were looking at, and one of the problems with investing today is that if you go into any financial advisor, they're going to show you what's happened over the last 10 years or so. And as I mentioned before, I think the last 40 years, last 10 years were exceptional periods because of the constant reduction in interest rates. And I think those years are over, and I think that world is over. So looking backwards, to me, trying to figure out what's going to happen in the markets, it's like driving your car by only looking in the rearview mirror. So here's what I think I would do. So any money that I need in less than 3 years, so let's say it's for a home renovation, a new car, sending a grandkid to college, whatever it might be, medical, I would keep it basically 100% in cash, short-term investments, GICs that match that period. So I'm not saying put all your money in this, but money that you know you're going to need, right? I just wouldn't take any risk. If your time horizon is 3 to 10 years, then I think you can be a little more aggressive. And my personal allocation is to look at about 50% in dividend stocks, such as using one of those ETFs I showed you, about 40% in bonds or GICs, but I want to keep about 10% in cash, put it into one of the so-called high interest savings accounts, pays 2.9% at the moment. But I want to have some cash around just in case. And then if you're looking at 10 years or more, then I think, again, you can be more aggressive. You can go into 80% diversified stocks, some bonds, still want to keep some cash around, but you can be definitely more aggressive. But the overall theme, I think, that we need to adapt going forward, the theme I heard recently where they said, prepare, don't predict. Nobody knows what's going to happen over the next number of years. It's just, it's just a crapshoot out there. So, but you want to be prepared in case things do happen that might affect you, so that if they do happen, you don't get stung. I mean, a good example, I was reading about Florida and the fact that in a lot of the areas that got badly hit in Florida, less than 28% of people had flood insurance. I mean, this is in a place where, floods happen, but people had convinced themselves that it wasn't going to happen. And rather than pay up, because flood insurance is not cheap, only 28% had it. So if you're investing new money, you have an inheritance, win the lottery, whatever, right now I would suggest that you take your time in investing it, don't rush. Markets could go down a lot further. They're down about 25% now, but in 2008-9, they were down 45% as they were in 2001. So you can develop a plan, put in X dollars every 3 months in a organized fashion, decide what you're going to invest in and just do it. I have a number of acquaintances who've sold their houses in the past while, and that's what they're trying to do. They've got some serious money to invest, but they're very concerned about not losing money. Beware of taxes, of course. If you're dealing within a tax-deferred account, RIF, RSP, TFSA, you can do anything you want. It's not going to affect things. You can move from mutual funds to ETFs. You can move it from one financial advisor to another. No effect. If you're in a taxable account, however, you need to calculate your capital gains tax before converting, because that capital gains tax can be 20 to 25%. And it may make it uneconomical to convert. If you're only going to save, say, 1% or 1.5%, and it's costing you 25%, well, it's going to take you almost 20 years to recoup that difference sometimes. In terms of how do you select ETFs, because I've just given you a very broad view here, there's a couple of areas that you can go to. Rob Carrick in the Globe and Mail every year does an extensive ETF buyer's guide where he goes through Canadian, US, international, bonds, whatever. Well worth looking up. And just to tell you now that Rob Carrick, who's excellent, by the way, is going to be the presenter on November 2nd for a webinar that's sponsored by NAFR Ottawa and NAFR Canada. So, and Rob's going to talk about how to invest in a volatile world, which we certainly have. So I highly recommend that you watch the Rob Carrick webinar. The other place to get some good ideas is moneysense.ca. It's a magazine. They come out every year with the best ETFs, and they also talk about the best robo-advisors. So robo-advisor is an online advisor who you can deal with that'll set up a portfolio for you. Costs a little more, but a lot cheaper than going through your local bank branch. And MoneySense gives you ratings of all these. The other thing is that if I can persuade you to set up your own discount brokerage account, online brokerage account, just note that all the big banks have them. And it's easiest just to work with the bank that you're already working with. You can ask people in your bank branch to help you set up the account. I've done that a couple of times for my wife and daughter. They've been very good. I'll mention that RBC Direct has a very helpful thing called a practice account, so that once you set up your online account, you can set up to have $100,000 in play money, and you can practice making trades and buying things and see how it works. And I think that's a really, really good idea. It costs in Canada a maximum of $9.95 per trade. Doesn't matter if you buy $1,000 worth or $100,000 worth or $1 million worth. Some are lower than that. And in fact, I saw recently the National Bank is charging nothing for their trades. Independents like Questrade, Wealthsimple are also offering no commission on ETF purchases. So some ideas of how you go about setting up an online brokerage account. And finally, just wanted to close with the reaction from your former advisor once you moved to ETFs. Just to set the stage here, for those of you who have seen the musical Hamilton, you'll know what this is about. For those who haven't, basically Hamilton is about one of the lead characters in the United States War of Independence, Revolution. It takes place just before the war, during, and after the war. This particular piece is from King George III at the beginning of the war. Please watch.
You say the price of my love's not a price that you're willing to pay. You cry in your tea, which you heard in the sea when you see me go by. Why so sad? Remember we made an arrangement when you went away. Now you're making me mad. Remember, despite our estrangement, I'm your man. You'll be back, soon you'll see. You'll remember you belong to me. You'll be back, time will tell. You remember that I served you well. Oceans rise, empires fall. We have seen each other through it all. And when push comes to shove, I will send a fully armed battalion to remind you of my love. Da 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 da. You say our love is draining and you can't go. You'll be the one complaining when I am gone. And now don't change the subject, 'cause you're my favorite subject. My sweet, submissive subject. My loyal, royal subject. Forever and ever and ever and ever and ever.
Okay, well, maybe your financial advisor doesn't dress quite that well, but anyway, that's what they'll be saying when you move to a robo-advisor or set up your own online discount fund. Anyway, I'll take questions now and turn it back over to Paul. Thanks, Paul.
Thanks very much, Michael, for the excellent and informative presentation. We already have a number of questions submitted in the chat box, but I encourage others to do so as we go along. And any that Michael hasn't had a chance to answer before we reach the end of the session today, please, we will take them into consideration and hopefully get back to you. Here's the first question. Over any 5-year period, has the market ever gone down apart from the Great Depression of the 1930s?
The answer is yes, it has. And in fact, the only period that you can be, say, 95% sure that the market won't go down is a 10-year period. And even then, there have been one or two periods where the market has gone down. So, but most people feel that 10 years or more, you're reasonably safe, that the market will at least come back to equilibrium.
Thanks, Michael. Here's a second question. What suggestions do you have for GIC timelines? Right now, my bank is offering me 4.5% for 1 year, but other years are a lot less. So is it best to put a large amount in your GIC or in your RIF?
Yeah, well, that's a hard one to know the answer to. I mean, it's interesting if the banks are offering more for a shorter period of time. It's an example of the inverted yield curve that I was talking about, which means that they think that recession is coming and that when recession comes, interest rates go down. I have no idea what's going to happen. And usually every time I guess, I get it wrong anyway. So I think the answer is, you can, what some people do is they build a ladder so that they'll take, say, 20% of the money that they're going to put in a GIC, put that in a 1 year, 20% in a 2 year, 20% in a 3 year, and go on. And then as they mature, they roll them over. And that way they get the benefit of everything. But trying to guess what's going to happen in interest rates over the next while, I don't have a clue.
All right. And here's a question that I'm sure a lot of us have asked ourselves in the past. Last year, I moved my RRSP from my bank to their online platform to save on the fees and give me more options, all with no tax implications of moving. It took 3 weeks between the time they converted my RRSP to cash and then transferred the cash to my new online account. Being out of the market for 3 weeks was no big deal then. My husband is thinking of doing the same, but is scared because of current volatility in case he ends up cashing in his bank RRSP at the bottom and needing to buy the ETFs in the online account at a higher price. Any tips on timing to avoid this?
Yeah, that's a good question, because I've noticed that also, that it can take them a very long time to send over the investments. By the way, just I'll mention one of the things, that if you do this, ask your new bank or fund to cover any expenses, any fees that the sending bank will charge you, because they will charge you a fee, typically $135 to $150 per account. I'm not sure how to get around that. And I'm not sure if you can do a partial move, but that might be the solution. And I've never checked into that, Paul, so I don't know. I've just always done it all at once and bit the bullet. But perhaps one answer is to do a partial move, where you cash in, say, a certain amount of mutual funds, and you move just a piece at a time to try to even out any of that time risk.
Okay. Eventually comes a time or event when one will no longer be able to manage a self-directed portfolio. Any idea of how to set up for such an event? If a spouse or heirs are not able or interested in managing the account, are there firms or advisors that one could retain? And if so, do you have any idea how much they charge?
Well, one quick solution is the robo-advisor, as we mentioned. So, for example, Wealthsimple is the largest robo-advisor in Canada, and their fees total, including the ETF fees, depends on the size of your account, but they run between 0.8 and 1%. So 0.8% and 1%. And they will continue. The other way that some people do it is to deal with one of the trust companies who will handle your estate and at the same time manage your investments. And you can talk to the trust companies whereby they will help your spouse if she survives you, or your kids if they survive you, manage the money, but again, at a fee. And then there are some independent financial advisors. There's a site that lists them, and I'm trying to figure out what it's called. But I think, in fact, I think it's something you could ask Rob Carrick, because he does know this, where you can get a list of financial advisors who are certified financial planners and who also take on a fiduciary responsibility, meaning that they will do what's best for you. But I just don't have it at the tip of my tongue right now, Paul.
Okay, well, that's certainly another reason to tune into Rob in a few weeks. What are short-term investment options other than GICs for your RIF investments?
Well, there are some other things, but they're a little complicated. There are things called split share corporations. And I almost hesitate to get into it because it's a bit hard to explain, but they're special investment funds that are set up where they will invest in a group of high-paying dividend companies, typically financial companies. And what they do is they divide the assets into two different units. And one unit gets all the capital gain and the other unit gets all the dividends and acts like a preferred share. So they're called split share corporations. There's 10 or 12 of them listed. You buy them like a stock. You'll have to Google it to get more information. They are currently yielding 5.5% to 6% as a dividend, as a qualified dividend right now, which means held in a taxable account, that's equivalent to about 7.5% interest. So as I say, I don't have time to explain it all here, and they are a little bit complex. But the other thing is that you can buy them that have fixed termination dates, depending on when they were set up. And those fixed termination dates range from about 1 to 7 years at the moment. And basically, no matter what you pay for them, on the fixed termination date, you'll get back the par value, which tends to be $10. Most of them are selling below par value at the moment. So say at $9.50 or so. So split share corporations.
Okay, thanks, Michael. The next three questions I'm going to lump together because they all relate to what should I do during this very difficult, turbulent time we have. I'm currently sitting on a lot of cash. Should I sit on it in the current environment or invest? Do you think GIC rates will increase over the next year as we go through these tough economic times? And is this a good time to invest in gold?
Yeah, well, that's quite the plethora of questions, Paul. You know, it's really hard to know. It's just really hard to know. And I can only tell you what I'm doing. I can't give people particular advice because they have their own particular personal situation. But in my case, my family's case, we've got about 60% of our assets in really good dividend paying stocks, about 10% in gold mining companies, because gold tends to do well when everything else does poorly. A little bit in bonds and these split share corporations I was talking to you about, and about 10% in cash. And so that's what I have right now. Again, who knows what interest rates are going to do, what the stock market's going to do, what Putin's going to do. So you have to basically come up with a portfolio that you're comfortable with and that you can sleep with. And that you know that even if it goes down in value, at some point it's going to come back up. And in the meantime, it's going to be giving you some income that you can reinvest if prices are low.
Okay. Is a TFSA as simple as you don't have to pay any tax because you're investing your after-tax money? Can you give a Coles Notes version of how it works?
Yeah, well, that actually was a very good definition right there. TFSA, you use after-tax money. You have a maximum amount that you can put in per year, which I think now is $6,000 per year. But you have contribution room that builds up since the TFSA was first started. So if you haven't put anything in at all at this point, I think the total contribution room is up around $70,000. And basically, yeah, you can invest in anything in a TFSA, any type of stock, mutual fund, ETF, whatever. And when you take the money out, you pay no tax on it. The other nice thing about the TFSA is that when you take the money out, you're allowed to the next year, not the same year, but the next year, put the money back in as a recontribution. So you can keep topping it up if you've got the funds available. So it's a really nice way for people to generate income from dividend or other type stocks, because as you pull that money out to spend it, you pay no tax on it.
Okay, here's another one that relates to strategy, and there are obviously quite a few coming up. In a severe recession, historically, has there ever been any part of the economy or business world that grows or thrives?
I don't know. I've been looking for that myself, and I haven't been able to find it. I think in a severe recession, everything gets hit. The only thing that seems to do well in a severe recession is sometimes gold and gold miners. So that when interest rates drop, stocks drop, everything else drops, the world looks really bad, it's going to end, gold tends to do well as sort of the last resort. The other thing that tends to do better than Canadian is the US dollar, which tends to, again, to be the investment of last resort.
Okay, there is one participant who just wanted to say how much they like your hat presentations. The blue one in the first session was an impressive color, and that may be time for me to put on a hat that I got on the Armenian-Georgian border about 10 years ago. Do you have any opinion on structured notes?
Very elegant, Paul.
Thank you. Do you have any opinion on structured notes? Can do-it-yourselfers buy this and the fees for that? I'm not sure exactly what that question is. Perhaps you can, and maybe it's, are there fees for that? Yeah.
Yeah, I'm not really familiar with them because I haven't looked into them. I've never bought them. The answer is yes, there's fees. There's always fees. But in structured notes, the fees tend to be hidden inside them. And for that reason, I'm just not sure that they're a good investment or not. I remember some years ago, somebody came up to me in one of the seminars and said she had bought this investment and there were no fees. And that wasn't that amazing. There were no fees. And I said, you bought them from a bank? I said, does the bank really, really like you an awful lot that they're not going to charge you any fees? I said, trust me, there's fees. You just don't see them.
For an actively managed portfolio, what is your opinion on using market trailing standing sale orders? And you might want to explain exactly what those are as well. So.
But I think they're talking about stop loss orders. A stop loss order means that if you buy something at a certain price, and if it goes below a certain price, you put in a standing order that if it hits a certain price, you automatically sell it. That's for active traders. I'm not an active trader. I'm a buy and hold forever, hopefully, kind of investor. So I really don't have an opinion on it because I frankly don't know enough about it. But, you know, I guess what I would say is 99.9% of investors should not be active traders. They should get really good ETFs, high quality, that invest in very high quality companies, and just plan on keeping it forever. Don't do anything. You know, I'm pleased to say that over the last 6 months, I've done virtually nothing with my portfolio.
Well, that's a very interesting observation. For the 10% cash I want to hold in my RRSP, are HISA ETFs a good option?
Well, they're an option. They don't pay much. They're paying, I think, 2.5 to 2.9%, but they're an
Can you
option.
maybe just explain what they are, the HISA?
HIS, high interest savings account.
Okay.
And virtually all the big companies have them available. They call them different things, money market funds, whatever, but they're basically a fund that you can put your money in, and you can get it out within 24 hours by selling, and there's usually no fees to buy or sell. Last time I looked, as I said, they're yielding around 2.9%. You can obviously do a lot better with a 1-year GIC, which I've seen as high as, I think, 4.15%. And it depends on how much flexibility you need. So if you want maximum flexibility, they're a good option. If you're willing to sock your money away a bit longer, and you can live with a year or 2 years, then GICs or split share corporations are better options.
Now, relating to GICs, are they available in a TFSA? Is that a vehicle you can use?
Absolutely. Yeah, no problem. Lots available. If you have an online broker, you can find under their research area the GICs that they have available. And if you have any problems finding it, you just call up their helpline, and they'll tell you about their GICs available. But yeah, basically you can hold anything in a TFSA that you can hold in any other account.
Okay. Now, relating to your slide earlier on REITs, you mentioned that they have not done well recently. Do you see a recovery in the next 3 to 5 years? A little bit of crystal ball gazing.
Yeah, well, they're down about 25%. And they're yielding around 4.6%. So whether they recover or not, like, don't bet on the recovery, but just take the 4.6 or 4.8% yield, which is pretty good. It's usually a good time to buy things after they've been beaten up, not after they've just gone through the roof like Shopify shares. So, I don't know if they're going to go up in value or not, but again, if you're just looking for income, it's not a bad source of income, and you've got the potential for some capital gain.
Okay. Is there a site that you can find the best GIC rates for various years so that you can do a comparison?
Yeah, there are some sites that you can find. And I'm just trying to think of what the names of them are. But there's, I think if you just Google best GIC rates in Canada, you'll find a number of sites that will give you a list of all the sort of the different banks and what they're offering for GICs. It's not hard to find.
Yeah, one of our participants just typed in what I was going to suggest, which is ratehub.ca.
Yeah, exactly. That's the one I was trying to remember the name of it. Good suggestion.
Yeah. Now, Michael, we're just about at the time where we need to wrap up. Are there any overall words you'd leave with the group? I mean, i.e., the last 2 or 3 days have been pretty scary. What would you say, or anything you've mentioned to date that you'd like to elaborate upon?
Well, I think try to figure out a portfolio that's right for you and your time horizon in terms of your needs. Keep your fees as low as you can. Diversify. Don't take excessive risks. Seniors don't have to take a lot of risk. We have to remember, if you're 30 years old investing and things go south for 5 years, you got a lot of time to make up that money lost. But if you're 60, 70, 80, you don't. And the other thing people forget is that, a 25% decline, to recover that, you require a 50% increase. The unfortunate math, and a 50% decline means you have to have 100% increase in the value of that thing. So my approach is to not take a lot of risk. In my own personal case, as I say, I'm sticking to really super high quality dividend paying stocks. and I'm not doing anything once with my portfolio. And my biggest secret though, Paul, the most important thing is don't look at it. Just put it away, leave it, maybe look at it once a year. And other than that, forget about it and you'll do okay.
Okay, well, that's encouraging and useful strategy and advice. Thanks to participants for participating in today's webinar. I hope you found it useful, and a huge word of appreciation for our presenter, Michael Fine. I want to remind you to keep an eye out for our follow-up email, which will include information on how to access the recording of today's webinar and information about the Mega Recruitment Drive. We hope you will decide to participate and refer new members. Ottawa branch needs your help so that we can continue to offer great webinars and other experiences to our members. To register for any of our upcoming branch events, including webinars, please visit our website at nafrottawa.com. We will make sure to include our website address in the follow-up email. Thank you, and see you at our next webinar. Merci beaucoup et au revoir.
Thank you. See you. Bye now.